The housing bubble has finally popped. According to the Case-Shiller Index, home prices have been coming down since June of 2022. I know a lot of you are thinking, well, George, prices haven't come down in my area, or prices will never come down in the future because supply is just too tight. Let me tell you, Jerome Powell sees your home equity getting in the way of him bringing down consumer price inflation. And I can guarantee you he has a game plan to crush the housing market, possibly bringing the price of your home down by 50%. Editor, cut to the clip.
The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
So just the other day, Jerome Powell was in Washington, D.C. talking to lawmakers, and he made it very clear that he is willing to take interest rates like mortgage rates, much higher and take them there much faster than the market had previously anticipated. This is the first step of his three-step plan. We're going to go over all of them on this video right now. Okay, so let's start by going over the terminal rate. Well, what is this? The terminal rate is the ultimate interest rate level that the Federal Reserve sets as its target for a cycle of rate hikes or cuts. It is the long-term target rate at which the Fed believes prices will be stable and they'll reach full employment. So this chart goes all the way back to June of 2022, all the way to today's date. Might be a little lag on it, maybe a couple weeks. And on the left, we go from 3% up to 6%. So back in June of 2022, the terminal rate, what the market was predicting, was right around 3.5%. It goes down in July, then it goes straight up till we get to October. That's very important because that's the last time that mortgage rates got above 7%. They dipped down slightly, but then they have gone straight up to where they are today. Just after Jerome Powell spoke the other day, this terminal rate went all the way up to 5.75%. And there were some groups, like everyone's favorite mega fund, BlackRock, that said that they're predicting the Fed will take rates up to 6% before they will stop. Before we go any further, I want to talk about some psychology with Jerome Powell. In fact, I want you to put yourself in his shoes for a moment. Would you rather be remembered as Arthur Burns or as Paul Volcker? It's an easy question. Every single one of you most likely said, well, Paul Volcker. Why? Because history remembers him as having the guts, the huevos, to break the back of inflation. And by the way, in the wake of him breaking the back of inflation, he caused a huge economic recession. But he was willing to sacrifice the economy in order to do what is right over the long term. And right now, I think Powell is thinking about his legacy in the exact same way. If he's going to err, he's going to err on the side of caution. In other words, taking interest rates a lot higher than he otherwise would to make sure that history remembers him like Paul Volcker and not Arthur Burns. Now let's get back to the whiteboard, go over the next chart. This is the Case-Shiller Index. It goes back to January of 2022 all the way to today's date. The blue line stops, we'll call it right around December of 2022. On the left, we go from 280 up to 320. This is an index, so these aren't actual home prices. And we can see that prices in general going up all the way to June of 2022. Well, why is this important? Because that's when interest rates, or mortgage rates more specifically, got up to 5.81%. I'm talking about the 30-year fixed rate. And since that time, prices have come straight down. Okay, well, let's think that through. Right now, we fast forward to today, and mortgage rates, once again, are over 7%, putting some extreme downward pressure on prices. But the Fed funds rate is only 4.5%. Okay, Well, the market is telling us that the terminal rate now is 5.75% based on how hawkish Jerome Powell was the other day. And again, BlackRock even coming out and saying 6%. So if we just attach this same delta, which is about 2.5%, to the rate the market is predicting the Fed funds will go to, we get mortgage rates at 8.25%. Well, if we go back to here and we see that 5.81 started to make the real estate market wobble and prices come down, what will prices do, assuming mortgage rates get up over 8%? At the end of the day, it's pretty basic. If the Fed funds rate goes up faster and higher than the market previously anticipated, that means mortgage rates do the same thing and housing prices respond by going a lot lower, possibly even 50% lower. And I'll tell you where I'm getting that number at the end of this video. Step number 2 of Powell's plan to crush home prices is OMO. Open market operations? No. Actually, got to give a huge hat tip to my good buddy Peter Schiff, who rebranded this and said it in a way that's far more accurate. Instead of open market operations, he said now it should be called open mouth operations. And I completely agree. I'll explain why in just a moment. But let's start this step by going over really a staggering chart. I could not believe this when I pulled it up online. It goes all the way back to 1950 to today's date. On the left, we go from 0% up to 6,000%. You say, George, what on earth is that chart? It's the Case-Shiller Index, i.e. home prices, versus consumer price inflation, the CPI, headline CPI number. Headline CPI in blue. So compounded since the 1950s, that has gone up right around 2,000%, which sounds like a lot until you look at how much the Case-Shiller Index has gone up. Now, it has come down recently, like we pointed out in step number 1, but from 1950 all the way up to where it's come down recently, it was up 6,000%. So why is this important? Because insert the Phillips curve, or we'll just abbreviate it to PC. So this Phillips curve in the Fed's mind equals purchasing power. So if you don't know what the Phillips curve is, it's very simple. We've got unemployment at the bottom, inflation on the left. So according to the Phillips curve, as unemployment gets lower, this most likely means inflation gets higher. And as unemployment goes higher, inflation gets lower. Why? Because as more people are employed, there's more purchasing power in aggregate total within society or within the economy. Okay, well, if they're looking at the Phillips curve, trying to increase the unemployment rate to bring down inflation or to bring down aggregate demand, to bring down the purchasing power of society, what do you think Jerome Powell is doing when he looks at this chart? Especially considering, of course, here's Jerome Powell right here. When he's looking at this chart and in the back of his mind, he's thinking about his legacy. He's thinking about this guy, obviously Paul Volcker. And he's saying to himself, this delta between the CPI and the Case-Shiller Index represents massive amounts of purchasing power, meaning massive amounts of inflationary pressure. So if I want to be remembered as Paul Volcker instead of Arthur Burns, I need to get this number a lot closer to this number. And to illustrate exactly how he will leverage open mouth operations in order to achieve this goal, editor, let's go right to the internet.
This is straight from CNBC.com. No exit ramp for Fed's Powell until he creates a recession, economists say. And this article quotes him from that testimony that he gave lawmakers in Washington, D.C. the other day, the clip that we use at the beginning of this video. But after he went out and spoke very hawkishly, he said that he was willing to raise rates faster than the market anticipated. And finally, a Goldman Sachs economist says last weekend we noted that consumer spending in particular poses upside risk to growth, meaning upside risk to inflation, if realized, might lead the FOMC to hike by more than currently expected. Okay, but this is exactly what Jerome Powell said. And you see, guys, this is exactly my point. Jerome Powell knows the market hangs on his every word. So if he comes out and talks tough about how he's going to raise interest rates higher than anyone can imagine, and he's going to take them there very, very quickly, and just you wait and see how tough he's going to get on consumer price inflation. He's going to bring it right back down to 2%, even if he has to sacrifice the stock market, or even if he has to sacrifice the housing market. You see, all the financial players, the mainstream media, the average Joe and Jane hear this, and they become defensive. They spend less money. They buy fewer houses. They buy fewer cars. They buy fewer risk assets. And as a result, just by him talking tough without even raising interest rates, he can also potentially impact consumer price inflation moving forward. And I believe he knows darn well that one of his most effective tools is simply psychology. If the market believes he's going to do something, they behave in a certain way, anticipating what he says he's going to do. Therefore, he doesn't even have to do it. Or if he does, in terms of interest rates, he doesn't have to hike them as high as he otherwise would have. This is what my good buddy Peter Schiff is talking about when he refers to open mouth operations instead of open market operations.
Step number 3 in Powell's plan to crush home prices is quantitative tightening. This is the opposite of quantitative easing, where the Federal Reserve is reducing the size of its balance sheet, mostly by allowing mortgage-backed securities to roll off their balance sheet. So they're not buying any more mortgages, which means those mortgages are going to have to be bought by the private sector. This plays right into Jerome Powell's plan to reduce the amount of equity you have in your home, to reduce overall purchasing power in the U.S. economy. So the question becomes, do I think Jerome Powell's plan will work? And the answer is yes, to a certain degree. Now, do I think that he'll be able to bring inflation all the way down to 2% just based on what he's doing? Probably not. In order to get there, I think we'll have to have some sort of black swan event, financial or economic crisis, that is not part of Jerome Powell's plan. But I do think that home prices will come down. I think they could come down up to 50% in the next few years. Let me explain why. This is a chart going all the way back to 1980, all the way to today's date. On the left, we go from 3 up to 7. It measures the average home price relative to the average income, or the price to income ratio. So going back to 1980, it was about at its historic norm, call it 5. Okay, well, what happened is the price to income ratio started to go down to the point where in 2000, it was very low, meaning that people's incomes were very high relative to home prices. But you guys know what happened then. We go into the largest housing bubble of all time, so you'd expect the red line to skyrocket. So prices became very, very expensive relative to people's incomes. Well, why do incomes matter? because that's what people need to pay their mortgage. So we have this big crash, the GFC, and home prices come all the way down, bottom out around 2012. And as you would expect, the price to income ratio reverts to its historic mean. You'll notice with home prices or things involving the real estate market, this mean reversion is very common. So where are we today? Well, we're actually higher than we were at the peak of the bubble in 2006. And it's not just the price to income ratio. Editor, go ahead and throw up a chart of price to rent, and you can see the exact same thing playing out here. So I think the key is to look at where home prices were adjusted for inflation. That's very, very important. When I'm talking about the housing market coming down by 50%, I'm talking about real prices, not nominal prices. But if you go back to that chart and look at where prices bottomed out in 2012, when you look at all the other data, it makes a lot of sense to me that prices would go back down to that level. In other words, revert to their historic mean. And I know a lot of you are saying to yourself right now, oh, George, that's absolutely impossible. Prices will never go back down to where they were in 2012, even when you adjust for inflation. Okay, let's go through some quick math. For those of you watching right now, would you say it's safe to assume that maybe over the next 5 years, on average, the United States sees, let's say, 10% inflation, 8%, 9%? I don't think that's too outrageous based on what we've seen over the past couple years. And do you think it's possible that home prices are just flat in nominal terms over the next, I don't know, 5 years? Well, if home prices are flat and we have 8, 9, 10% consumer price inflation, that means home prices in real terms would come down by almost 40%. There are no certainties, there are only probabilities. But when you look at the charts, when you look at the data, when you adjust for inflation, I think most of you would agree the probability is very high that home prices get crushed over the next few years. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.